You're listening to the Unlocking Africa podcast.
I had the opportunity to do some financial structuring and project finance deals for energy projects in sub-Saharan Africa, and I have never left the continent afterwards. As you know, in capital markets, size matters a lot. The amount of time my investment team is spending on doing a deal of 500K or doing a deal of 5 million is approximately the same. Effectively, you cannot get a company full of debt. There must be some skin in the game. There must be some equity in there. The speed with which developments are currently taking place is phenomenal. We haven't seen this before.
Stay tuned as we bring you inspiring people who are unlocking Africa's economic potential. You're listening to the Unlocking Africa podcast with your host, Tessa Adamu.
Welcome to the Unlocking Africa podcast, where we find inspirational people who are doing inspirational things to unlock Africa's economic potential. Today, we have Roeland Menger, who is CEO of Nithio, which is a climate fintech platform that makes investments to clean energy companies and helps others allocate capital to climate solutions that build resilience. Welcome to the podcast, Roeland. How are you?
Thank you, Teresa. Very nice to be here. Thank you for the invitation. I'm doing well, thanks.
Brilliant. So, as always, I like to try and set the scene. So I was hoping you could give us an introduction and tell us who Roeland Menger is.
Yeah, sure. Starting at the beginning, I'm trained as an engineer, master's in energy science, moved into offshore wind R&D, then financial engineering for offshore wind. And after a couple of years of doing consulting there, I had the opportunity to do some financial structuring and project finance deals for energy projects in sub-Saharan Africa. And I have never left the continent afterwards. Started working for Off-Grid Electric, nowadays called Zola Electric, in a capacity of corporate finance, raising capital, structuring debt. Moved on to equity investment side of EDF, the French utility that has been focused on off-grid as well as energy projects, renewable energy projects, that is, in sub-Saharan Africa. Moved to Paris for that. I'm Dutch, by the way, so I'm from the Netherlands. And after my return from Paris, I started to do freelance jobs, helping companies, startups, and projects across sub-Saharan Africa to raise capital, to structure their finance, to materialize on exits as well. Did a bunch of things ranging from agriculture to agroforestry, energy, even some pharmaceuticals, always with a climate adaptation or climate mitigation angle. That's close to my heart and important for me to work on. And in that capacity, I joined Nithio, which is 3 years ago, and since then moved into the CEO position of Nithio quite recently.
Fantastic. So you've worked across a range of global organizations, I believe from Google to World Bank, Power Africa. So was there something specific that led you to Nithio focusing on climate fintech in Africa, which is quite niche?
Yeah, it's a very good question. I entered the scene around 2014, 2015, doing a mini-grid project in Madagascar as a pro bono project. So doing the financial structuring of mini-grid and spend more than a month in the little village called Andavadaka, depends how you pronounce it. A fisherman village of 4,000 people without any electricity and with a very simple solution, which was this mini grid. So solar, centralized solar with some cables going to the houses. Suddenly there's electricity, meaning more economic activity because the fisherman used to go on the seas each day to catch a fish and then eat the fish. Very simplistic way of explaining this. But with power, obviously, you can start planning. You can catch more fish and save them for a rainy day. You can start doing business. You can start selling fish, trading them to the village next door, which was predominantly doing charcoal. So there was these very local economies that have been built up. And this basic infrastructure of power helped to, for example, create water, and the water, like the sweet water from the wells, helped to grow tomatoes. And so from this single focused village that just goes out in the ocean every day and eats fish, we go to a blossoming economy that's doing trade with neighboring villages. And that's just because we put some solar panels and some batteries there. And that was a mind-blowing shift for me. And since then, I decided to start working on these type of projects and put my knowledge to work in this way. And so that's how I ended up doing some other mini-grid projects, and then ended up with off-grid electric, where we did solar home systems, which I don't know if the listeners are familiar with, but it's a very basic system that you can think of on any off-grid household that has no electricity. You supply not only the solar panel and the battery, but also the appliances. And it's all on a lease-to-own basis. So people pay on a weekly, daily, or monthly installment, and they have the power. And at the same time, they have very energy-efficient appliances. So instead of what we've seen with mini grids, where you sell power to people and then people need to buy an appliance, obviously they buy the cheapest appliance, which are older appliances, and so they consume a lot of power, which actually is good for the unit economics of the mini grid, but bad for the people. Shifting this towards solar home systems, where the total system includes energy efficient appliances, including nowadays also productive use appliances that are very energy efficient. You can minimize the expenditures on solar panels, on batteries, and so you optimize systems from the ground up.
Brilliant. So you've gone from pro bono work to allocating capital to climate solutions. So in simple terms, can you explain Nithio's main facilities and how they are addressing Africa's clean energy financing gap?
Yeah, sure. So starting from this solar home systems, as I just been discussing, those systems are, as I said, on a lease-to-own basis. So the people make a daily, weekly, or monthly payment to unlock the system. So it is as simple, back in the days, it was as simple at least as people texting a code that cost them 50 cents or $1, and then they get a code back, they type it into their system, and then the system works for the pre-charge time. Nowadays, things are very more advanced and sophisticated and more automated, but the core methodology of daily, weekly, and monthly payments still exists. And so you supply a customer somewhere in rural sub-Saharan Africa with a solar home system. Somebody has no credit history. We have no other history on somebody other than the GPS coordinate and the type of system that he or she is using and paying for. So how do we assess whether or not such a person will pay off the system? And that's where Nithio comes in. So this has been a challenge for companies in this sector because the assessment of the credit risk and the credit scoring is very difficult. And so you end up actually charging quite a high interest rate to all your customers for this lease to own basis, simply because you cannot forecast whether or not somebody will pay or won't pay. So effectively, people that are paying, subsidizing, or paying a higher interest rate for the ones that won't be paying. So if you have better intelligence on that, we have a more fair market, the prices can go down, and you can get commercial capital allocated to this market, because suddenly you can actually rate it. You can say this is a B-rated portfolio of receivables. So that's where Nithio started their journey. We figured a way out using AI and satellite data and buying a lot of other data sources like socioeconomic data, demographic data across sub-Saharan Africa. And with a machine learning tool, we cross-check existing repayment patterns and behaviors with like millions of data points, like the GPS coordinate can tell you already not only where somebody's located, but using satellite images, I can even say if it's a small house or a large house, if it's close to a road, if there's already electricity there. Even from the reflection, you can see if it's a building made out of wood or out of stone. So these are millions and millions of data points that you can get from this single data source nowadays. And using our AI tool, we started to combine all those millions of data points and start recognizing patterns. And then we take those individual borrowers, and we will not classify an individual person as a good or a bad payer, because that feels very discriminatory, especially if you're using AI to determine that. So instead, we aggregate them into archetypes of fast repayers, moderate repayers, and slow repayers. And based on that archetype typical profile, we can start forecasting on an entire portfolio what the amount of capital is that will come in. And so instead of saying, hey, Terza is a really good payer, please give him a loan, we say, show us your entire portfolio of receivables of hundreds of thousands of people with such a solar home system, and tell me how much money you expect from them. And if they say we're expecting 5 million, then we can calculate that actually our forecast can calculate that approximately 4 million will come in. And so discounted cash flow, you can value that even to what's that worth in today's money, given a certain interest rate. And so that tool has been developed simply to help the market allocate their capital smarter, unlock commercial capital to this market, and also help the companies to have a better understanding of what is the real value of all these receivables that they have.
Brilliant.
That's a very long answer, perhaps, but I'm not there yet, unfortunately. Because when we developed this tool, we saw in market that there was a gap for financing these receivables as well. So we decided, let's eat our own dog food. Let's go out, use our tool, and start financing these pools of receivables. And so we raised capital, we set up an investment vehicle for that, and we started handing out loans against these receivables portfolios. And that's what we've been doing. So the tool has been built since 2018, and since 2021, we allocate our own capital to it. And currently, we have an investment vehicle with approximately 50 million of assets under management, to which we hand out loans to these companies for those receivables.
Brilliant. So as you mentioned, Nithio uses an AI-powered risk analytics engine to assess borrowers. So how would you say this technology has changed the game for specifically financing clean energy in Africa?
Well, the objective is to unlock commercial capital. I mean, there's so much commercial capital available that if we find a way to allocate that capital to these type of borrowers, then we're winning. And so currently, most of these companies and portfolios are financed either through grants, like the smaller ones, or through impact-focused capital, DFIs, Development Finance Institutes, like double bottom line type of financiers. And there's a limit to that. And what we see using our AI tool and how this should change the game that we're in is that we can, as I said, accurately say this is a group of fast repayers. They will most certainly repay. And so put your money there because it's a very low risk category group. And here's a group that might struggle a bit more. And here's a group that will struggle really, really hard. And so effectively, as we do in capital markets worldwide, you can determine what kind of capital you allocate to which group. So instead of having a complete bag of unknowns, and it's just like, yeah, like if everybody will pay, this is worth 5 million. What do you pay for it? You have no clue. I can say in this bag, there's a layer of 2 million that definitely will pay. So I can find capital in any commercial market that will allocate the capital to that. And then there's this layer of, well, they'll struggle. So I can find more catalytic capital that's willing to take that risk. And then there's this big group of people that actually will struggle a lot to repay. And so I can efficiently allocate grants and subsidies to that group of people so that they have the electricity as well. And that's a way more efficient approach, and hence can unlock way more capital to this market than the way we're currently looking at it, where each investment vehicle is blended finance. So there's part commercial, there's part development money, there's part grant money, and we allocate that as a bulk to an entire portfolio, not knowing the specific layers in such a portfolio.
Thank you for sharing that. You mentioned double bottom line financiers and how your blended finance model is more attractive to investors because it reduces risk while still delivering impact. But we still know that many investors do shy away from small, local, clean energy companies. So what's your approach to making them bankable?
Yeah, that's a really good question. As you know, in capital markets, size matters a lot. I mean, the amount of time my investment team is spending on doing a deal of 500K or doing a deal of 5 million is approximately the same.
Yes.
But if you charge each of them 10% interest rate, I'm going to make way more money on my 5 million deal than my 500K deal. And so it's easier to recuperate the cost of deploying the investment manager to such a deal. That's what we see at large in market. That's why there's investment vehicles that have billions of assets under management that won't come out of their bed below 100 million. Like if you go to any large bank, Citibank, Société Générale, whatever, we need to come with a deal or a package north of 100 million. Otherwise, it's not attractive for them. Coming down this layer, there are investment funds and vehicles in our space, in climate finance in sub-Saharan Africa that are also focusing on 5 million ticket sizes, 10 million, as low as 2 million. But below that, there's nobody actually looking into because it's not efficient from a unit economic perspective. So what we're trying to do is, because this AI tool is already automating a part of your financial due diligence, which is the credit scoring aspect, we try to automate more and more of the rest of the financial due diligence as well, using novel tools like the past 1 to 2 years, the large language models, so a different type of AI, has been growing so rapidly that nowadays they can easily read out financial statements. They can start calculating ratios. They can start assessing forecasts. They can even, like AI can easily look at a financial model and do some scenario testing and some sensitivity analysis. So if we can do that all automated, then we should be able to do way smaller deals because we don't have to spend that much money anymore on investment managers. And the investment manager will remain, obviously, to keep the oversight, but we can do a larger volume of deals with a higher margin because there's nobody catering to that market. And that's the direction that Nithio is taking. From an impact perspective, this is huge as well because these are not the multinational companies or the startups that come from Silicon Valley or London and have huge pockets of Tesla and other backers. These are like the locally owned, locally operated companies that actually go out and market. They see an opportunity, they see a gap in market, and they address that. And they start setting up a business, selling these solar home system assets, productive use appliances. And those are the companies that we really like to find and fund. Because if we are the first-time borrower to such a company, if they can show that they actually repay, then on the back of that, we're comfortable to lend more money to them. We connect them to our equity network, so equity investors can put some capital in. And so we grow with such a company to become a larger player in market. And that's a huge gap. If you want to go right now in Nigeria and take out a 100K loan, it's impossible. You're too small for local banks. You are too large for microfinance institutes. You can go to a loan shark and you pay 100% monthly interest. That's your only option.
So I guess if we look internally in terms of some of your facilities, I guess the main facility is FAIR. If you could kind of walk us through that. What is that facility? What does it do?
Yeah, so our main investment vehicle is called FAIR, Facility for Adaptation, Inclusion and Resilience. So this is the investment vehicle that we set up to do loans to this sector that we address with our data. So this is the vehicle that I told earlier about, where we allocate our own capital to lend to companies. And currently we lend to companies ranging from 500K to 5 million ticket sizes, ranging from locally owned, locally operated companies in Kenya, Nigeria, all the way to regional or even multinational companies. Like we lend to the Sun Kings and D-Lights of this world, but as well to local companies that are locally owned, locally operating. We have a mandate to invest in 20 countries in Sub-Saharan Africa, and specifically Sub-Saharan Africa because we have the satellite data for that. We have satellite data for Sub-Saharan Africa on 1 by 1 square kilometer accuracy. And so anywhere in Sub-Saharan Africa, we just need a GPS coordinate and the asset that somebody's financing, and we can add it to our risk analytics engine and see what the projected repayment profile will look like.
Brilliant. So I believe FAIR operates in 20 countries with investments from Nigeria to DRC. So I was wondering, how do you decide which markets to enter in Africa?
Again, a very, very good question. So we have an investment team in Lagos, Nigeria, and in Nairobi in Kenya. And so those are the regional offices from which we do our investments. So obviously, a majority of our investments currently sits in Nigeria, Kenya, Uganda, those regions, right? Looking ahead, we look where are the opportunities, what are markets that are growing, which companies are active in those markets, what's the competition for those markets, as well as what's the macroeconomic outlook for it. So an example, if I raise capital in euro-denominated capital, I'd rather go to Francophone Africa because I eliminate my currency risk. So my euro-denominated capital, I'd like to put to work in Senegal or Cameroon or Benin, right? In Francophone countries using the West African franc. If I get US dollar denominated, then Nigeria is quite dollarized nowadays. Liberia is a dollarized, fully dollarized economy, no currency risk there. And so, so we look at macroeconomic trends. We see what's happening, which companies are operating there. For example, we invested recently in Altec in the DRC because they are doing really well in that market. It's a huge market. It's an underserved market. It's a locally owned company. So it ticks all the boxes. And so it's always a tailor-made. It's not that we have a blanket approach and say, well, Senegal looks really good or Cote d'Ivoire looks really good. Let's go there. It's always an approach of it needs to be the right company doing the right thing in the right market.
Welcome to Verto Corner, your weekly cross-border insight powered by Verto. Today we're talking about expanding into new markets and how payments can make or break that process. Here's Alice Williams, Expansion Operations Manager at Verto, with what businesses need to know. Take it away, Alice.
So I'm here to talk a little bit about barriers to entry into new markets, which is kind of exactly what I do at Verto. The way I kind of think about this is I go through sort of steps. Obviously, we do quite a big discovery stage when we're looking at new markets. And the way we would kind of structure that is, firstly, we would do a lot of local research. So we really need to understand the kind of big picture, the kind of political, economical climate of that country. What are the challenges? Are there any kind of regulatory hurdles from like the central banks, or could political instability or even conflict impact our operations? So we also need to get on the ground and kind of listen to the local people, existing customers that have pain points in that country, and basically consider what kind of businesses we'd be targeting and how we could meet their needs in this kind of new environment. So we'd have a bit of a local research phase. Probably the next and probably most important step, I would say, is the kind of regulatory context. So once we have that local research, we move on to that and get a kind of legal lay of the land. Like our summary here is like super, super crucial. Do we need a license to operate, or can we work with a licensed partner? What would that look like? The specific requirements, for example, for compliance or licensing and even reporting to central banks, that would probably make or break an expansion. That really, really is such an important step. And then we'd move through to like market sizing. So what is the kind of share of the market that we could go after? What's the total addressable market? What part of that market is already served? And obviously looking at competition, who are the major players and what's their market size? And, would we be in addition to that? Would we be offering something different? And what kind of growth channels would we be looking for there? So I think to kind of get a clear view of that total opportunity, we realistically need to get some sort of target and share that we could capture. And obviously, like size isn't everything. Competition is important, but it's really where do we fit alongside that? So I think we'll do things like a competitor matrix, for example, and just kind of see where we would sit within that. And that's quite helpful to sort of visualize what we could do. And then really looking at options to entry. I mentioned it at the beginning, but how would we actually want to move into this market? Would we be looking at potential partners? What could they offer us? Do we need to incorporate locally? Do we need to get an entity set up there? And obviously there are pros and cons to each. Setting up an entity and going for licenses is probably more the sort of long-term play, but you might be able to find a bit of a quick and dirty entry where you partner with a bank or a PSP that is already licensed and already able to offer you that kind of local operation. And you can kind of sit on top of that and bring your products and what you offer to that partnership. So there are a couple of ways to enter these regions. And I think when we look at partners, I've built, I'm sure like many people, built like a scorecard of what partner would be best for us. So I would look at the regulatory side of things, the synergy it has with Verto, like could we work together? How would we work together? And are we kind of compatible in a kind of technology sense as well? So what would their technical capability be? Obviously, commercials, that's a big one. Like, is this a commercially viable partnership? And then also, I think probably what's kind of overlooked is actually when you're not in country and you're working with a partner, you really need to know they're reliable. And so like a big part of my scorecard is actually like reliability and their communication style, because I get that that can differ from country to country. But I think if you're on the same page there and you can really be like, hey, something's going on, we need to sort it out, that really helps. And that really carries a lot of weight with the partnership. So overall pricing, I think, is another part that we would look into, in a sense of going back to the kind of product side, like, would we be a fit there? What can we offer? Would we be a low cost option for people there? What's the fit like from a pricing point of view? And then the very final stage that I would look at in this is decisioning. So we've got all these scorecards within here. So every kind of market would have its own write-up, a score. Partners have scorecards within that. But really the kind of decisioning is just, can we actually win this market? The answer is more than just yes or no. It's kind of the rationale that matters a bit more. So can we be successful because our pricing will make us the most competitive, or is our product superior in a way? You know, we've just launched a new bulk payments feature. Is that something that is readily available in that country? And is that something that's just going to be a game changer for some of our clients that want to operate in that country? You know, settlement times, are we the best there? And so it's not necessarily the yes or no, it's actually the sort of rationale behind what kind of uniqueness could we bring to that market and can we win it? By scoring each country based on these factors, we can kind of create a bit of a country ranking. And this is a really data-driven approach that kind of moves our decision from this sort of, oh yeah, everyone's talking about Ghana, for example, to this sort of strategic choice for Verto.
You've touched on quite a few key areas, but before we go, just one question to wrap things up. From all the clients and companies that you've worked on, what's your single best piece of advice for market entry success?
Yeah, so I think probably my best piece of advice would be do your research. I mean, that seems really obvious, but I think if you don't do your research, you can do a whole lot of work and you'll get blocked by something that you just have no control over. And so I think the regulation piece, the compliance piece is such an important part to get right. So get to know your local regulation. How can you set up? How can you stay compliant with those local regulations? Can you build this into your product? Like, has this got legs? Is this going to be an entirely manual process that is going to be really, really hard to get around? You really want to be able to have something that is scalable as well. You know, what would your regulatory strategy look like? I talked earlier about setting up an entity and getting licensed. That is a huge amount of investment. Is the quick and dirty entry a possibility to then grow later? And is all of that worth it? So I do think the kind of regulation and compliance is most important. I think we do a lot of planning, but we have made mistakes in the past. Like I remember we opened up a country and basically we were almost there and we'd relied a lot on our local knowledge of the central bank there from our banking partners, who obviously we thought were the kind of industry experts. And what we hadn't done at that stage was actually get more of a legal on the ground opinion. And we got quite far and then we realized that we couldn't actually open a bank account in our name without incorporating. So that was maybe the quickest incorporation I've ever done, just so we could get a bank account. And so really it's about doing your research, but asking multiple people as well. Like, don't rely on your partners to tell you everything. You need to talk to local people, local clients, go to the local regulatory body and explain what you're trying to do if that's suitable, and really find out as much as you can.
Thanks to Alice Williams for breaking down what smart expansion really looks like. See you next time on Verto Corner. And now back to our interview. Keeping on the theme of looking at opportunities, I guess the opportunities also drive your objectives and targets. I know that one of your targets is replacing 190,000 diesel generators by 2028. How critical would you say that goal is for Africa's clean energy or climate and energy future?
Yeah, so the objective should be bigger than that. The objective is, in my opinion, if you make sure the basic infrastructure is there, then the rest will follow. Like if you have cheap, clean, affordable, reliable energies, like I always say, you need to care for all, clean, affordable, reliable energy for all. If we care for all, then my opinion is that the rest will follow. You can use energy and electricity for so many things, for from telecoms and being connected to the world to pumping up water from wells, irrigating your land, in your factories, making sure that you are able to produce goods, process goods. Everything starts with energy. And so Sub-Saharan Africa, it's huge. It's so large that from a European point of view, people don't fully understand or realize that. And the fact that it's so large and so sparsely populated in some regions, it really, really doesn't make sense to make electricity lines like in other parts of the world. And so we shouldn't be making a mistake of trying to replicate the infrastructure that we currently have in Europe and say, let's just build large power plants and electricity lines. Because we are in a different era right now. This is the new economy where everything becomes more decentralized. Energy becomes decentralized with solar, with batteries. And so you can build a way more efficient system if you do it the right way around. And that's what we're trying to achieve here. I always say Nithio is not necessarily focused on climate mitigation projects. We don't do large power plants. We are about climate adaptation to make sure that when climate change hits, you have the tools and you are equipped to deal with those. And so you need power. You need for drought, you need power to irrigate your lands. You need power to stay connected to the world, to understand what's going on. You need power to get along in this new economy of data and AI and everything's being automated. And so if you do not have power, you cannot automate things. That's my core belief. So we specifically say diesel generators here simply because that's also decentralized and currently largely used in sparsely populated areas in a very inefficient way. And we believe that can be done much simpler, better, cheaper, and more reliable as well.
You touched on something interesting there in terms of the focus on climate adaptation, which obviously requires you to understand where the growth is. So beyond solar home systems, are there any other target areas that you're focusing on with your work, your activities?
Yeah, coming from solar home systems is just a start. From there, we look at productive use appliances to make sure that your energy is allocated to economic activities to help you grow, to help economic social development. We are looking at e-mobility, for example. We think that electric boda, like the motor scooters, make way more sense than an internal combustion engine. They're cheaper, they're more reliable, and they're better for the environment. And so, yeah, we range into, as said, climate mitigation is at our core. So anything ranging from solar water irrigation, cold chain storage, grinders, to process goods and food, to transport like e-mobility, to even telco towers, for example. I mean, most of the telco towers that ensure the connectivity is there are now still driven by diesel generators. That must change. We can do that with solar and batteries, way cheaper and more efficient and more reliable again.
Thank you for sharing that. The solar irrigation market is an area of interest to me. We know that it is growing quite substantially. I think the last I saw was at nearly 10% annually. How do you believe this area can potentially transform African agriculture specifically?
Well, I think it starts with making sure that indeed you can be more resilient in a phase of climate change. So with more heat waves, more drought, but also more irregular rains, rainy season patterns change. We already see that. And when the rains come down in some areas, they come down so hard that actually it destroys your entire harvest. So making sure you're set for that is very important. So solar water irrigation is not just making your life easier because you don't need to fetch water. It is also making you more resilient. It is helping you to fully utilize your plot of land. So an example, because there's vicious circle effects here. If because of drought, your land is not irrigated properly, and then suddenly the rains come, it's more likely that your land is eroding. And so when your land erodes, then your harvest is gone. So torrential rains will happen more often. But if your ground is already, your soil is in good health, it will help you to combat those. So people always think, oh, well, it combats drought, but it also combats rains. So solar water irrigation is just a first step into this process. And we see many more of these areas that we hope to see more companies become active in as well. Like the solar water irrigation currently, Sun Culture is a famous example. We invested in Sun Culture. It's a great company with a great team doing very important stuff. In the future, I hope that they'll get more and more competitors that will be entering this market as well to make these products more available for everybody.
E-mobility is another area that you touched on, and it is often underestimated in Africa. So what's your take on its potential for both urban and rural transportation?
Yeah, so the people that drive a boda, so I keep saying boda, but like it's the electric motor scooters.
Yes.
Most of them, they're businessmen. And the motor scooter is used to transport people, to transport goods. It's a very efficient way of getting around, especially if you're used to the traffic in Nairobi. You're very happy that the bodas exist. At the same time, most of them are very old. They're using quite a lot of fuel. They are noisy. They are pollutant, and especially in cities, especially in larger cities that also have so. For example, Freetown or Antananarivo, where actually your city is built inside some mountains. Like it can become very, very bad for your health if you have a lot of these motorcycles driving around there. So the electric one is it's simpler, it's more reliable, it's cheaper as well, and not polluting. So it's very straightforward, and it's a very simple change because a boda driver, as said, he or she is a businessman, driving goods, people, using it for all kinds of measures to drive revenue, to drive income, to pay for the fuel. So instead of paying for fuel, you just pay for battery swaps, and then that's it. So it's almost a no-brainer. You see a lot of companies coming up. Spyro is the manufacturer, Ampersand, Rome. All of them have their own unique business models on, for example, the battery swapping or on selling motorcycles or the loan behind the motorcycle. So it's a buoyant market, and we are looking into entering that market at this moment, indeed.
Interesting. So we touched on solar home systems and also your growing interest in other areas such as solar irrigation and e-mobility, which all requires capital. I know you're currently raising for junior capital. Why would you say this layer of capital is critical for scaling impact?
Yeah, so we have a permanent investment vehicle, which is a very difficult word for saying that our investment vehicle is effectively run like a normal company. So in any normal company, you would raise capital and you use that capital. What we do is we raise debt and we raise equity to hand that money out as loans again downstream in market to these companies for which we assess the credit scoring using our tool. So as any other company, we have leverage ratios to adhere to. It means effectively you cannot get a company full of debt. There must be some skin in the game. There must be some equity in there. In order to financially structure and optimize such a structure, you can have different layers. So what we did is we have senior debt, we have junior debt, we have preferred equity, we have common equity, and we have a grant funding into this vehicle. And each layer has their specificities. So the senior debt is the most secured one. It's the one that gets their money back the first. Therefore, they have the lowest interest rate. And with them, we agreed that there's a certain limit to the amount of senior debt that we can get. Because obviously, if you would get 90% of your capital from senior debt, the seniority of it is less relevant than if you, let's say, get only 50% of your capital from senior debt. Because effectively, if you only have 50%, you only need to get a return 50 cents on the dollar to be fully returning the capital to those investors. So that's the rationale behind, very simply, behind financial structuring. We currently sit in a position where we have a lot of interest for the senior debt layer, and to be able to tap that and to be able to utilize that in market, we need to get more junior capital. So people that are willing to take more risk and are willing to, they can receive a higher interest rate for that, for taking on more risk. Or there's other metrics that we can steer on, like gender equality, or other impact-related measures and metrics that we can steer on. So we're very happy and open to those conversations, but that's simply what we need. So the more junior capital we get in there, the more people that are willing to take a risk, the more of that senior capital I can deploy. And so, like, a rule of thumb is anybody who will put in 1 million of junior capital in FAIR at the moment will immediately unlock 4 million in deployable capital in the market. So therefore, we're looking specifically for junior capital.
Thank you for breaking down. You've broken down how that leverage works in practice. And I know with that, you're also trying to grow assets under management. I think, was it from $47 million to $80 million by this year?
Yes. Yeah, correct.
Yeah. So I was wondering, what has been your biggest growth challenge within this process?
It isn't the size and the tipping point that you need to achieve to become interesting for large capital allocators. And so it's a bit paradoxical, because when you're small, you want to grow, you want to get more capital, obviously. But the people that can put in large capital at once have their limitations on their differentiation. You do not want to put in $20 million in a $20 million fund because you have all the exposure and all the risk. So first you need to grow to a certain point after which you can become interesting for larger capital providers. An example, I said previously, like Citibank and SocGen, they will not get out of their bed below 100 million. But they also have this limitation that they can only be max 30% or so as a total exposure of the fund. So to be able to access that 100 million from them, or to actually talk with such a bank, you need to be already a fund with 300 million of assets under management. Otherwise, it won't work. And trickling down, that works also in smaller ticket sizes. So many development finance institutes also have a minimum of 10 million. They cannot do a smaller ticket size than 10 million. But then again, if I only have 25 million of assets under management, which is where we started, then 10 million will become 1/3 of the total exposure. And they say, well, it can only be 1/5 of the total exposure, because that's where we set our limits. And so you need to gather a lot of smaller tickets to actually grow to a certain size before you can actually tap that larger ticket. And then the growth will accelerate. Because the moment I'm beyond, so the 50 million where we're currently sitting at, that's a tipping point. The moment I'm at 60 or 70 million, I can take easily 15 to 20 million ticket size. So I become interesting for investors like IFC, who ideally do anything above 20 to 25 million. So they cannot come in when I'm at 50 million, but they can come in when I'm at 70 million. And so with them coming in with 25 million when I'm at 70, I'm suddenly almost at 100. And when I'm at 100, I can get people coming in at 30 million per ticket size. And so your growth accelerates after you've reached that tipping point. And so that's been the biggest challenge, to actually reach that tipping point and overcome that tipping point.
You've just touched on this in terms of the opportunities that can be accessed as you grow. So I was wondering, where do you see the biggest untapped opportunity for climate finance in Africa over the next decade?
I think, and this is also because it's my background, but in financial structuring, there's huge gains to make. Because there's very little commercial bank activity in climate finance in sub-Saharan Africa, because it is deemed too risky or too exotic. Especially when macroeconomic tide turns, you always see that capital allocators flee from their most risky assets. So whenever we have a downturn, a global downturn in macroeconomic downturn, the money is pulled from emerging markets first, meaning that effectively, anytime there's a downturn, there's less capital available for these markets that need it the most, and actually that grow the fastest. And so right now I see that still there's very little commercial capital being deployed into these climate finance projects in sub-Saharan Africa. But at the same time, there's huge balances. Like companies and banks raised big green bonds, and there's a lot of capital that has been earmarked for climate finance in general, globally. Right now, for example, I'm in the Netherlands. I'm Dutch. Like a Dutch pension fund cannot allocate their earmarked climate finance budget anymore in the Netherlands because our grid is congested. You cannot add any wind farms or solar farms or whatever anymore to the grid. Like it's officially on pause. Like you cannot deploy that capital because there's no projects that can be developed. So they're sitting on it, but at the same time, they can also not deploy it in Tanzania because that's not on their green list. That's too risky for them in their terms. And so this mismatch of a lot of climate finance capital available and the willingness to deploy it, but then the hurdle that they cannot deploy it in Europe at the moment, and they are not able to deploy it in sub-Saharan Africa either. That's something that needs to be fixed. And that's something that I hope Nithio can play a role in by making these layers, as we discussed earlier, more clear. So the structured finance component on making clear this is a very low risk investment. So this is great for your pension fund to step into. And this way, getting commercial capital mobilized into these markets. So within a decade from now, I really, really hope that most of the climate finance capital that's actually being deployed in sub-Saharan Africa is commercial capital, because I think we can make it. I think the market is there. It's just a matter of transparency on it to make sure people fully understand, and structuring of it to make sure the right layers are addressed by the right type of capital. Commercial capital for low risk, development capital for high risk.
Brilliant. Thank you for sharing that. So with that in mind, if we look closer to home, what's your vision for Nithio and what role would you play in this? What will success look like for you personally?
Yeah, so for me personally, I'm really enthusiastic about this move into more automation. So we built our risk analytics engine in 2018. And whenever I tell people right now that we're working with an AI risk analytics engine, people automatically think in these large language models, because that's what all the news is about, OpenAI, ChatGPT. But there's so much more in artificial intelligence that we have already built and we are refining. The speed with which developments are currently taking place is phenomenal. We haven't seen this before. The thing that we built back in 2018 with a large team of data analytics can today almost be built by artificial intelligence itself. So you can have artificial intelligence build artificial intelligence. That fact makes my belief that if we put that to work rightly, we can further automate a lot of these processes. And by doing so, being able to really address that market that's currently completely overlooked and underserved, which is this SME market in sub-Saharan Africa. My personal view on success will be that in 2 years from now, there will be a platform online at Nithio. And if you're an SME in Nigeria or wherever, you can just go online. You upload your financial statements, you upload your projections, your CRM data, and you tell me how much money do you need, 50K, 100K, whatever. And within 72 hours, you get it either approved or rejected and get it into your bank account, and you can start deploying it. That's the way how capital markets could be working. They're already working like that in other regions of the world. So having that ability to then have SMEs really scale, because the shoestring of capital and budget is not there anymore. They have access to global capital markets as an SME. That's huge.
Quote of the week.
As people, we often have quotes, mantras, proverbs, or even affirmations that keep us going when times are challenging or when times are good. Do you have one that you can share with us today?
Yeah, sure. My mantra is very straightforward. It's accept the things you cannot change the things you cannot accept. And that's how I look at my work, my personal life. And yeah, I really stand behind that. And there's so much that needs to be fixed in this world and that can be fixed. So that's what we should be addressing.
Nice, concise, meaningful, impactful, just like the work that you're doing. Roeland, thank you for sharing your journey and giving us such a powerful insight. And it's also good to see how innovation and data can drive impact and inclusion. So yeah, thank you for that. Absolute pleasure having you on the podcast today.
Thank you so much for the invitation once again. A really big pleasure to speak with you today about our work. Thank you.
Thank you to everyone who has listened and stayed tuned to the podcast. If you've enjoyed this episode, please subscribe, share, or tell a friend about it. You can also rate, review us in Apple Podcasts or wherever you download your podcast. Thank you and see you next week for the Unlocking Africa podcast.